Are we good to go? Yeah, good. We'll make a start. So, good morning, everyone, and welcome to Taking Stock After the Bell, episode 25. Here with my colleague James Hughes, as always, and we are delighted to be at the Findlay Park Partners office to meet with Anthony Kingsley, the Chief Investment Officer. Anthony, good morning.
Good morning.
Quick bio for those of you who are interested. So Anthony is the Chief Investment Officer of Findlay Park Partners and a portfolio manager and managing partner. Anthony joined Findlay Park in 2002 as one of the founding members, along with James Findlay and Charlie Park. He was appointed Chief Investment Officer in 2017 to oversee the investment team and take responsibility for investment decisions for the American Fund. Prior to joining Findlay Park, Anthony worked at MFS Investment Management in Boston, working as an equity analyst covering various UK European sectors. And before that, out of university, Anthony joined Foreign and Colonial as a graduate trainee, where he first met James Findlay working on the American desk, where James ran the US Smaller Companies Fund and Investment Trust. Anthony has an economics degree from University of Bristol, and his hobbies include tennis, beekeeping and calisthenics, which I had to look up, which is exercises that solely rely on body weight, such as pull-ups and handstands. So how's that going?
That's pretty good. I started out doing yoga about 5 years ago and sort of evolved a little bit into calisthenics. I always like to try new things. I wouldn't say I'm particularly good at it, but
Instagram's been doing this to me actually, because I do a bit of yoga and follow various people, and it has started showing some videos of calisthenics, but it looks far too difficult for me. So you might have to give us
do some handstands and headstands afterwards.
Yeah.
Well, when we turn the video off, I might
we thought we'd do that on the second time you come on next time around, or we'll get you to doing some headstands and things. But the Findlay Park American Fund has just crossed its 25th anniversary, which is quite a milestone. I would say it's not quite achieved yet. We've just passed our 250th anniversary, which is fine, but you're on
10,
the road.
isn't it?
Exactly. We've got a chart here of the performance of the fund in total return terms since inception, relative to the alongside the MSCI USA index, and the fund is up 20x, which is pretty impressive. So the units were launched in '98 at $10 a unit, and I checked this morning. The unit price was $204 a unit. So that's a pretty decent return, right? How's it been?
yes, it's been fun. And obviously we've managed through all sorts of different market environments,
100%.
from bull markets, bear markets, Asian financial crisis, NASDAQ correction, great financial crisis, COVID, interest rates at zero, interest rates normalizing. So we've seen a lot of different types of environment, but have managed to compound reasonably well through that.
Do we know what the compound rate is? 13% or so?
It's just over 12 after fees. Yeah.
12% a year. So
I was going to ask, what's been the most challenging period?
The most challenging period I find are the ones where fundamentals sort of diverge from reality, and you're left as an analyst, as a portfolio manager, as a decision maker. You just have to sort of put your hands up in those moments and say, the market is a voting machine, but in the long term it's a weighing machine. So I'm referring to, meme stocks and
I was going to say
huge
2020,
bubbles
2021,
where you just things sort of depart from kind of reality. But as I say, over time it's been enjoyable. We try not to spend too much time thinking about the macro and really are focused on companies. Have we got the right companies that are going to compound? And that's been the key to our success, having the right companies that can compound earnings and free cash flow and deliver that growth. And so that's what we're sort of maniacally focused on.
Yeah, I think we can all get a little bit too bogged down in what's happening to ISM services and the job report every first Friday of every month, and et cetera, and that in itself is kind of interesting, potentially stimulating. And if you're a macro hedge fund, that's great. But if you're trying to run a fund that invests in equities long only, you should be more worried about what the companies are doing and how the companies are performing, right? So
yes,
that's quite a refreshing kind of.
Particularly if you're taking a long-term view, which we do. The average holding period for a stock in the fund is over 5 years, and so we're trying to sort of step back and take that long-term perspective.
Well, part of the reason we wanted to have you on was something that's popped up quite a lot with in the podcast over the last few months and years, is this sort of idea of kind of American exceptionalism, which may or may not be the title of today's podcast. But we've got a chart here of the US equity market in blue against the MSCI World ex-USA. So essentially, in red is the rest of the world. And it's fair to say that the US over the last, this is 30 years, has done pretty well, and has kind of, the gap has opened and done, US equities have done materially better than the rest of world equities. So we were sort of hoping to kind of touch on some of the reasons of that. I've got the same chart shown slightly differently here, which is a one against the other, or a sort of relative chart. So when this line is going up, we can see that the USA is outperforming, and when the line is going down, that means the rest of the world performing. And just sort of one thing to highlight here, it's not always been the case that the US equity market is outperformed. There have been times in history when the rest of the world, notably from kind of 98 through to 2008-9, the rest of the world did a good bit better, and to a degree in 2022 and 2023 as well. So, what we were sort of hoping to do really, Anthony, was try and sort of scratch the surface as to, why we might think that be the case. I mean, I've got a couple of other charts which I might just touch on before we kind of move on to that. So we've got a chart here, the valuation of the US equity market on a very sort of simple price earnings multiple, i.e. how cheap or expensive are US equities relative to their profits. And we can see that there is a pretty reasonable gap between the valuation on the US versus the rest of the world. But there's good reason for that. And the next chart here we've got is the earnings progression, and we can see, you talked about how what's important is the company's earnings and how they're doing, and that blue line here shows the progression of earnings on the US market versus the rest of the world, and we can see it's been a lot stronger. So I guess if you just sort of start at the beginning, why do you think that US companies have some of these inbuilt advantages, and then maybe we'll ask you, do you think it can continue? Which I think is probably what everyone wants to know.
Yeah. No, I think it's a really good question, and it's not one simple answer. It's really probably a series of factors which, when combined, create, I suppose, what I call a Lollapalooza effect. That was a term that I think Charlie Munger used, when you have things coming together and they magnify and they create this really sort of powerful impact. So just stepping back, to start with, it's a very big country, 300 million consumers. You can take a business model and you can leverage it quickly and easily over a large group of customers. So I think that would be the first thing.
And that's, I guess, in contrast to Europe. I mean, Europe has got 300 million people notionally, but of course you do still have barriers, and you have languages, and you have differences. It's not quite the same as the US, is it?
Precisely. Then you have very deep and broad capital markets. So, when you think about not just the equity markets, but, the early stage, the venture, private equity. So those deep capital markets and a history of investing long term. The whole VC market is really, you take a very long term view, and they've had that infrastructure in place for many years. And you've seen these companies that now dominate the S&P 500. At one point, those were startups in the last, 20, 30, 40 years, whether it's Apple or Microsoft, Tesla.
Infamously famous Facebook startup, wasn't it, at university? Was it MIT? Can't remember. Anyway,
Facebook, exactly. Yeah. Google, Nvidia, it was probably IPO'd, 25 years ago. So just this extraordinary also entrepreneurship, this culture of innovation, of investment, of entrepreneurship, of shareholder friendliness. I think that's something that is perhaps underestimated, the ability to drive companies and business successfully in a way that it's celebrated, and entrepreneurs are celebrated in America. And then you have a regulatory framework, a political and regulatory framework, again, that allows businesses generally to thrive. Yes, you have some antitrust issues, which we may end up talking about in some of these larger companies, it's sort of topic of the day. But you have, so you have a lot of the infrastructure in place. Then, in addition, I think over the last 10 years, you've had energy independence. So, a very low-cost source of guaranteed sort of energy supply.
A massive boon, isn't it?
America was an importer, now is an exporter of oil. And then a newer factor, probably in the last few years, is the reversal of this deglobalization. So reshoring and onshoring, which I think is a sort of, those ones that I mentioned already, they're sort of enduring factors, and I think they've driven probably much of the last 30 years. But I think the reshoring and onshoring and reindustrialization of America is going to be an interesting one that I think will play out over the next 10 years. And again, I think will help some of these domestic and smaller and medium-sized domestic companies.
I mean, you sort of geographically, I think there's something the other day about talking about the Red Sea and how that's impacting Europe and not the US, because geographically the US is so big, so difficult to get to, and it's virtually self-sufficient in its own commodities. It's got plenty of oil, it's got plenty of food. The basics, all the building blocks are there really, and you're right about that kind of entrepreneurial zeal as well.
It's also got very friendly neighbours north and south. And I looked at import-export data from Mexico. I hadn't appreciated how much is being imported from Mexico now. And actually, I think it's not quite 20% of imports. You would think it was sort of in the teens. But what I saw was the imports coming in. I think the original raw materials, 45% of those imports came from the US in the first place. So, as you say, it's that reshoring and getting your manufacturing plants or your local producers is just closer to the country.
No, that's right, and it doesn't rely on global trade as much as other countries. It's self-sufficient in food, in energy. So, as you say, you have these issues like the Red Sea, which are cause more problems for other countries than necessarily that does the US because of its situation.
And then, do you think that we're not going to talk about politics, but do you think the political framework is a hindrance or help? I mean, you touched on antitrust and things, and we've got an election. We don't want to talk about the politics of the election, etc., etc. But is Amazon and Google, are they great because of the political framework, or in spite of, in your view?
Well, that's a really interesting question. So, America has a business-friendly, pro-business culture, and so it's allowed these companies, whether it's a Facebook or an Amazon and Apple and so on, to get quite large. But at the same time, America also has a long history of breaking up monopolies. So, Facebook was allowed to acquire WhatsApp and Instagram and so on. But Facebook will not be allowed to make acquisitions, I would say, going forward, and they're under much closer scrutiny of the regulatory authorities, the FTC. We'll hear a lot more about this, I think, in the coming months and years. And to some extent, coming back to your question, these are quite political. Obviously, there were always a lot of questions around these social media platforms at a time of elections, and no doubt that will rear its head again, and we shall see. But I would say that is going to be a more of a headwind for those companies than it's been. It's been a tailwind to allow them to get them to where they are now.
Right. Absolutely right. And then on kind of valuation, and we'll put the chart back up again on kind of the valuation of the US market. I mean, the gap is there's a sort of the Graham and Dodd kind of value manager in me somewhere kind of looks at this and goes, well, you surely buy the cheap one and sell the expensive one, don't you? Is that right or wrong, do you think?
So
clearly it's been wrong.
The valuation has expanded, as you see on this chart, and it's coincident with the rise of these mega cap companies, so which have been growing very fast. Revenues 20%, 25% for a decade, and doing so with very high returns on capital. The business models of these companies are, have been absolutely fabulous. The scale economies, the synergies, the network effects, and so they've been growing fast, and they've been increasing their returns on capital. So when you have high growth and high returns, the valuation is a function of the growth, the returns, and the duration of those returns, and that is why you've seen that. I think if you X'd out the mega cap 8 or the Magnificent 7, which are 25 up to 30% of the index, you would probably find that the rest of the companies are not trading at those multiples. So then the question arises: well, what is the sustainability of the Magnificent 7, which is another topic which we can cover. But I think that explains why we've got, to some extent, why we've got to where we've got to.
Yeah, I think that's fair. And I don't have it off the top of my head, but I have a feeling that if you do X out the Mag 7, the rest of the market looks kind of okay, a little bit more expensive than the rest of the world, but not materially so. And then,
but I think that's probably our clients' biggest question, isn't it, around the Magnificent 7 or the Mega 8 is how can they continue growing at the same pace, and surely there's more opportunities elsewhere. One of the reasons we obviously own your fund, but it'd be interesting to see how these businesses keep performing going forward, because they have just been extraordinary.
And they've been really agile, because obviously they went through, I wouldn't say a bit of a bubble, but if you sort of look at Amazon in particular and Meta as well, 2020, 2021 obviously saw huge growth, probably over-invested, they probably overstretched themselves a bit, and then they saw some issues in 2022, and some of those stocks really were properly mashed up. Well, Amazon was down 50%, Meta was down 70%, but they took an axe to their workforce and their cost base, and we had Meta's results last Friday, and a $1 trillion company was up 20% on the day, which I find pretty staggering. And the main reason was because they brought their cost base down so much in the space of a year. So you're right, they've showed incredible agility through pretty big kind of turmoil the last 2 years, which continue to surprise me. I don't know. It's interesting. We've just taken on kind of Microsoft's Copilot kind of AI chatbot thing, and we've just had it released into our PCs this week, and that's another kind of strand that kind of Microsoft, and another kind of revenue line that they can generate. So it is pretty interesting.
Yeah. So we're an all-cap fund, a sort of core fund investing in America, but very much an all-cap fund. Today we have, give or take, roughly 10% of the fund in these mega-cap companies, compared to 25-30% of the index. And so we've taken really a very selective approach, ones that meet our investment philosophy, we think can be good compounders with a high inevitability of outcome. It's very easy to look at last Friday, Thursday, Friday, and look at Amazon and Facebook, and but we sort of step back from it. It might be interesting to hear about how we look at Amazon and Meta, and why we don't own those two. Not to say they're not fantastic companies, but I think I would look at it kind of on three vectors. The first one is competitive intensity. You look at the competitive intensity on Meta, and social media, they were once the dominant platform. They're still very, very strong, but it took, I don't know how many months for TikTok to get to 100 million users. There are always rival social media platforms. There will continue to be, and that is something that we are concerned about. On the competitive intensity side, on Amazon, AWS is very, very strong, but we're entering a new world of AI, and how will they be positioned in that regard? You've got Microsoft, you've got Google, you've got competitors on the retail front that you may not have had before. Even TikTok is doing a lot of commerce. So I think competitive intensity.
Temu, isn't it, from China, who are in the online platform that's pretty cheap.
Many others. So you've got the regulatory environment, which we talked about, and I think that's going to be a lot tougher. Alina Khan at the FTC has been sort of on a mission to look closely at Amazon. I think it's probably more on the retail side at this point. And we mentioned Facebook earlier, how it's going to be difficult for them to acquire. I think the final point would be on capital allocation. Meta is controlled by Zuckerberg. He went on this mission to spend a lot of money in the metaverse. Yes, he's pulled back. I think that's one of the reasons why the stock's done quite well. But I think against that backdrop, it's quite difficult as shareholders to really have any control as to what the outcome's going to be. And equally, Amazon, at times they will invest incredibly heavily into something, let the profits get squeezed. Right now, they're letting the profits grow and they're harvesting, but no doubt they will at some point probably be in investment mode again. The AWS businesses requires a huge amount of capital spending. So I think for various reasons we just feel they're not quite as good fits with our investment philosophy. It's not to say they couldn't be very successful.
And how about Alphabet? How do you view Alphabet through that lens, or Google?
Yeah, so Alphabet, we think the search business, we think they're going to maintain a very high market share of that for a relatively long period of time. Obviously, things can change there.
It's quite hard to envisage using a different search function for all of us. From a personal point of view, I just can't ever imagine clicking to try and find something in it not being good.
It serves the consumer, it serves business. It's not a consumer platform that is it's not quite as fickle. And so we think that core search business is strong with YouTube. You've got all these other bets outside of the core, which add up to a little bit of the value, with the majority being in search and advertising and YouTube. And the stock is relatively inexpensive. If it does get broken up from a sort of regulatory perspective, we think the sort of is worth more on the sum of the parts. And it's trading on GAAP earnings at a reasonable multiple. So. So that's how we look at it.
YouTube's potentially a long-term winner, possibly alongside Netflix, in terms of kind of media and how we view. I was thinking to myself this morning, I don't watch much linear TV anymore, apart from last ball. It's mainly YouTube.
Gladiators on a Saturday night.
Gladiators night.
My son, well, can we watch the next one? I'm sorry, you've got to wait a week. He just can't get his head around why you can't press play on the next one.
And then, correct me if I'm wrong, but you don't own Apple in the fund and haven't done for a while.
We've never owned Apple.
Never owned Apple.
Which a 3 trillion market cap from relatively nothing, has cost the fund, in terms of opportunity cost. But fortunately, we've been able to find other things that have managed to sort of compound at an attractive level, and that have met our investment philosophy checklist. So we will miss things, and Apple obviously is a wonderful company, a remarkable company. It's not a great fit with our investment philosophy.
I think for the listeners, what's extraordinary is to see how you've compounded over time without owning all of these big companies, because I think the view sometimes outside is you can't perform, or you haven't been able to perform without owning the 7 or the 8, and we talk about it a lot, but you have performed despite having those massive companies that dominate the index. So it's really interesting to see you can get these really good returns from your companies by thinking about things differently, and arguably we're diversifying our risk away as well.
Well, that's right. I think last year, 23 was a good example of that. I think the fund was up 27% after fees, and we owned just a small percentage of the mega cap. Most of the performance came from a diversified group of companies in various different industries, many of which were mid-cap companies as we define them, so sub $50 billion market cap. I know that wouldn't be a mid-cap in some other markets, but
top end of the FTSE 100, isn't it? $50 billion.
Certainly is, yeah.
But it's come back to sort of AI, which has been the kind of buzz phrase du jour, and it's getting some traction, it's taking off, and maybe ChatGPT is the potential threat to Google search. We don't know, but we'll skim over that for the time being. But there's lots of sort of talk about how do we sell shovels in the gold rush, and Nvidia's clearly been the classic kind of example. But do you want to kind of touch on what I think is a really interesting stock that you do own in the fund that's potentially a kind of good play on this, and how this kind of fits in with your philosophy?
Yes, absolutely. Very happy to. So Accenture is a IT services consulting company, very large, originally a partnership, Anderson Consulting, and it IPO'd.
Oh, did it come out of Arthur Anderson, did it, back in the day?
Yes, it was Anderson Consulting.
Oh, right,
and
so it came out at the time of the WorldCom failure? Or
yes.
Was it? Oh,
yeah,
right.
that's when they separated.
Right.
And they have grown and grown and grown, largely organically, but also through very small little tuck-in acquisitions. Today they have 750,000 employees,
Right.
most of whom are IT consultants and technologists. And when you look at the business today, it's a hugely fragmented market. So even though they're probably the biggest IT service company in the world, they, with $60-odd billion of revenue, they probably have a low single-digit market share of the addressable opportunity. Now, there's various different angles I can go with at Accenture, but you mentioned AI. There was a recent survey, I think, that 97% of CEOs said, AI is a priority for them.
Mm-hmm.
But I think less than 5% of them had actually sort of begun the journey.
Right.
And what Accenture really thrives on is change. If the world wasn't changing, there wouldn't be a lot of business. As long as there's change in the world, and we're going through a period of rapid change, Accenture has consistently adapted their business model to suit sort of where we are. So when we moved from on-prem to cloud, that was a big opportunity, and now AI. So AI, excuse me, $450 million of revenue this last quarter, which is relatively small on a $16 billion a quarter base, but nevertheless growing rapidly. What's actually really interesting is that in order to do AI well, you really have to be digitizing your business. You have to be moving your business to the cloud. Mm-hmm. And the cloud represents over $30 billion of Accenture's revenues. So 30 billion of, say, 65 is cloud. Yep. That business continues to grow double digit. Cloud penetration is still relatively small. There's a huge runway. And what Accenture will say is, if you want to prepare for AI, you need to move your business to the cloud. So in fact, that business, as they put their business into the cloud, these big corporates, in a way is a play on AI, and then you've got these areas of focus, whether it's financial markets, whether it's energy, life sciences, these strategic bets that they're making. And that business is ramping. So 450 million of 16 billion is 3% or so in a quarter, but no doubt we'll see it become 5%, 8%, 10%. And I think by the end of this year, it will. This is a sort of picks and shovels way of getting exposure to it. You can see the stock started to perform quite well, but I think there's a lot of runway here.
Yeah. It's interesting to see it hasn't quite got back to. It's some way off the peak of kind of
presumably that peak
in
21 was a kind of work from home kind of needing in consultants to sort out your work from home hybrid offering, and then all got a bit bubbly, did it?
It did. They had, this is a business which should compound revenues in the high single digits, say 6, 7, 8, 9. It was growing over 20% a year, and so we had to go through a period of digestion, of slowdown, but ultimately, Satya Nadella has said that IT spending will move from, I think he said this a few years ago, 5% of GDP to 10% of GDP. So IT spending is a GDP plus growth business. Sure. And therefore, if Accenture is participating in that and in fact taking market share, they typically outgrown the IT services market, they should be able to grow in the high single digits, expand margins, make acquisitions, buy back stock, and compound earnings in the teens. So this is a stock actually we held for probably close to a decade. Right. We then didn't hold it, and we came back in sort of at some point last year when the stock had sort of moved sideways a bit.
Just for the listeners and the avoidance of doubt, by the way, we don't do individual stock tips or solicitations to buy or sell securities on the podcast. So please don't rush out and buy a load of Accenture. However, interesting nonetheless to hear all about that. And you mentioned you sort of moved down the market cap scale, and we sort of touched a little bit on kind of reshoring and onshoring and a kind of industrial renaissance alongside kind of infrastructure bills and kind of trillion here for this and green transition. Do you want to touch on the stock that we've just put the chart up here for Martin Marietta and how that sort of fits in the portfolio?
Yes, love to. So Martin Marietta is a $30 billion market cap company, so a pretty substantial company. We have held in the fund for over a decade. In some ways, it's an incredibly boring business, but we like boring businesses actually that grow. And what does it do? So it has quarries. And it basically picks rock, mines rock, aggregates, so whether it's rock or gravel or sand. And the great thing about rock is that you can't ship it very far.
Yeah, of course.
And because it's heavy, and the shipping costs would make it not worthwhile. So you don't ship rock from China, unlike a lot of sort of foreign competition. So you don't get foreign competition. In fact, you can't ship this stuff more than about 50 miles. So it's actually a local oligopoly. And what they've been doing is they've been building market share in aggregates. And as a result, when you do that over time, you get pricing. So yes, there is pricing per ton for rock, but it's not like a spot market like oil or gold where you can trade it. In fact, prices never really go down; they only go up.
Yeah.
And what's happening right now is that prices are going up high single, low double digits. In fact, low double digits recently, because they've been building their share, they're building their local shares, and at the same time, these big infrastructure projects, what do they want? They want security of supply. If you're building a $5 billion semi-fab, it's a very small percentage of your cost, but you must have it. If you don't have it, you can't build it. And so they've been taking price. It's what we call a high-value, low-cost business. And we have, actually Accenture, I would say, is one of those. Martin Marietta. We probably have a large percentage of the portfolio, what we call high-value, low-cost business models, where what they provide is a very small percentage of the total costs of the product, but very critical. And so Martin Marietta can compound earnings and free cash flow, in our view, double digits for the foreseeable future.
So actually they've got great pricing power because, as you say, it's such a small percentage of the overall cost. It's almost not. It's less than
it's a few percent of the cost of the. If it's a house, it's a few percent of the cost of the house. If it's an infrastructure project, it's a fraction of a percent. And the wonderful thing about this business is, even if you don't have volume, volume is 0, 1 or 2%, you can get double-digit price, and we think that can last for a very long time. And so, I say, a very boring business, but one that is, I think, can compound for a long period of time.
And what sort of basic multiples does it trade on, if we were to compare it to S&P, for example?
Yeah, so over time, Martin Marietta has traded between 15 and 30 times earnings, roughly. And you might say, gosh, 30 times earnings, that's a lot. It is a fantastic business. With our view, a very high inevitability of outcome. We don't think you can replace the rock with something else. And so it has traded at a high multiple. Today it's trading at around low 20s, low to mid 20s probably. You can see the stock's had a move up here, so it's probably trading closer to the mid 20s now. But again, if you're confident in that free cash flow compounding, that should come down, materially over time. And so, the other factor is that as you increase prices, your returns on capital go up, and as your returns on capital go up, you should, all else equal, pay a higher multiple for the stock. So we're going through a period where returns are structurally increasing.
And the sort of Biden stimulus and infrastructure spending and semiconductor plants that you mentioned, it all kind of plays in, and green energy transition all kind of plays into eating a lot more rock, isn't it?
It does, and they are a purely domestic US business, which, incidentally, when you look at our portfolio, we have a bias towards mid-cap companies, sub 50 billion. It's close to half of the fund, and those tend to have a bias towards more US revenue. So this would be a good example of that.
And just for the listeners, what proportion of the revenue of the S&P and the fund is from the US? Because is it 40% of the US?
Around 60% is the S&P, and we're close to 70.
Okay.
Yeah. So you are, wholly kind of somewhat more American focused fund.
Yes. Those are round numbers. I may slightly.
And that's obviously because the mid cap side is far more domestically focused.
Yes. So we've got Martin Marietta. We've got heating and plumbing distributors that are very domestically focused. We've got lots of interesting little industrial companies, engineering and services companies that are more US biased.
On the sell side, are these sort of under-researched names, or they're still huge businesses, but do you think you can get you can miss sort of price anomalies a bit better in that mid-cap space than the larger businesses?
Definitely, I do. And I had some experience where I started out my career in the US, and then I switched to becoming a European analyst covering insurance and software and pharma for an American buy-side firm. And the reason I switched back to the US is I just felt that in Europe, if you had a really good company, it would be quite well picked over and well analysed and well covered, and probably have a little bit of a premium. It's amazing how many companies that there are of sort of 20 billion, 30 billion, 40 billion, and so on in America that don't have fantastic coverage, and they might have one or two analysts that understand it well. A few people have got their name.
Do you know
on
what?
it.
That really surprised me. My naivety, and you know, we obviously had the, you know, a brief call last week to catch up, and when you said that, I assumed that kind of the US market would be more mature and there'd be lots more coverage, but it's surprising that companies of these size are just not looked at in as much
I think
detail.
it's partly to do with just the size of the market. I mean, there are so many companies in America that of a size and scale. It's just a much deeper market. I mean, it's not to say there isn't coverage. There is coverage, and there's certainly a lot of buy-side coverage. You get on the conference calls, and there's a lot of questions. But I think there are still inefficiencies, which is what drew me back to the US as just this wonderful landscape for identifying opportunities and compounding, finding the quality companies with good returns, good businesses that can compound.
Interesting.
And one of the last stocks we've kind of asked you to talk about is perhaps one of my favourite businesses, because this comes back to the heart of the kind of low cost, high value, isn't it? If you're doing your tax return and your accounting software, you don't change that stuff, do you? Because it's got all your data in. So do you want to talk us through one of the stocks in the portfolio that I'm a fan of?
Absolutely. So Intuit, a wonderful business. Again, we've held in the portfolio for many years. It's a low-cost, high-value business. So the majority of their revenues come from two businesses. One is small business software, accounting software. QuickBooks, you may have heard of. They advertise quite a lot here in the UK. Very dominant market share of accounting software for small businesses. And then they have a product called TurboTax, which is tax preparation software. Everyone has to do their taxes. Well, not everyone, but 40 million tax returns that Intuit prepare, and they have the dominant market share, 60% market share of online tax returns in the US, and they charge a small fee every year and make a very high margin. So it's a wonderful business.
60% market share.
60% market share of the online tax preparation. Interestingly,
incredible.
Most tax preparation, most of the value, the revenue dollars are captured offline in the advice market,
right.
And
because there's a button you can press, isn't there? If you're putting your data in and you don't understand something, you can sort of link through QuickBooks and you can talk to someone, can't you? Which is an upsell essentially.
Exactly. So one of the really beautiful things about this business over the last few years is what they call Live. So QuickBooks Live, TurboTax Live, and they're moving up the value chain. So if you want to do a tax return preparation and you want to get advice 24/7, any time of the day, you will get directed to an accountant who understands through AI exactly where you are in your tax return, what your challenge might be, and will help try and solve that for a price that is more than the basic cost of the TurboTax tax return, but way less than what you might pay by going to a H&R Block tax store.
Sure.
And so they've been moving up the value chain, and this is why they've been growing in the teens. So their small business, amazingly, is continuing to grow in the upper teens revenue. Wow. Their small business accounting and payroll, and tax grows at around 10%. And so, again, they've been just moving up the value chain in both, and that's been driving great growth. They've got fantastic margins in the 30s, and you get to sort of upper teens compounding of earnings, maybe even 20%.
Yeah, no, it's a really great business, and the stock was a bit blow off toppy in 2021, isn't it? And it sort of, the stock went through a kind of bit of a difficult 2022. I mean, there was a lot of sort of macro concerns in here, isn't there? So if you're a company that's focused on small business and the world is worried about a recession, you're probably, a recession and small business closing down in the States is probably not good for Intuit's business in the short term. So, some of that froth has come out of the
I'd sort of look at it perhaps slightly differently. There was a bubble in these software companies. Interest rates were zero, market took off, and then in the correction, these high PE stocks just got hit very hard as rates went from 0 to 5% very quickly. So I think the multiple, frankly, was probably a little bit elevated. Yep. And at the same time, people were concerned about small business. But in fact, the fundamentals of Intuit's business when you look at this chart, have continued to compound earnings in the teens right throughout this. So the stock chart doesn't really do sort of justice to the business, which, has defied, any bear around, a small business slowdown. And so, that's why the company sort of continues to perform and the stock has recovered.
No, it's been great. And then we sort of move on, Anthony. I mean, we're in the midst of earnings season. Are we halfway through earnings season yet? Sort of quarterly.
Yes, I'd say we're probably over halfway through.
And then what are your sort of key takeaways so far? Is there any sort of themes that jump out at you? And we've talked a little bit about Meta, etc. But if sort of under the top stocks, what sort of jumps out at you as to how companies are doing?
I think what jumps out is the resilience of America, of the American economy, yes, we've had this adjustment from interest rates from 0 to 5 and potentially a housing slowdown and a consumer slowdown, but the consumer's resilient, the housing market's resilient, GDP growth it looks like it's going to remain reasonably strong this year, and just the resilience of America and their ability always to cut costs and manage earnings, manage margins. The one caveat to that is that we have seen a supply chain adjustment. So when you look at certain elements within, say, semiconductors or the consumer or industrials, there has been because supply chains were so constrained during COVID and they took on too much inventory, and so we've been going through an inventory destocking, and that has been impacting earnings to an extent. But it feels like we're getting through that, whether it's in healthcare and biotechnology, having too much bioprocess equipment, or analog semiconductors. We're sort of coming through that, and so I'm actually quite optimistic that we're coming out the other side of that, and when supply chains are normalizing. So. Look, I've always been hopelessly optimistic about America, have been for the last 30 years, and remain so. Take what I say with a kind of pinch of salt. But I think, by and large, what we see is sort of reasonably healthy.
Good. Well, it's good to hear. The market's sort of expecting 8 to 10% earnings growth for 2024 as a whole, which maybe, but if companies are as agile as you say, and there is no recession, and again, we joke now pretty much every week. If you go back to episode 1, when rates started going up, episode 1 was over a year ago. We thought there would be a recession. There's no way we thought that the Western world would cope with 5% interest rates without there being. And we had a bit of a wobble. The housing market in the US wobbled, and the housing market in the UK is sort of flatlined, and consumer spending's hardly gone to the races. But the US economy just carries on growing, and corporates are doing a very good job of managing their way through that. So, you've been absolutely right to have been optimistic for the 25 years that the fund's been in existence, and indeed more recently in the last 10 or so years. Any more sort of thoughts or anything that you wanted to pass on to the listeners, other than make sure you're not under-owned in US equities?
No, I think that's it. Just look, there's a lot of challenges in the world today. There's a lot to worry about, but frankly, in my investment career, there's always been something to worry about. But ultimately, if you buy good companies and leave them alone, and you've got confidence in their inevitability of that compounding, you should do pretty well over time. And that's what we try and do. Put together a portfolio of businesses that we think are world-class businesses. But if we're wrong, we're not going to lose too much money. We get things wrong occasionally, and just like everyone else, and then we move on. But no, we feel pretty good about America.
Good.
I'm looking forward to the great broadening out of returns away from
the top 7.
Away from the top 7.
Well, with that, thank you very much for your time, Anthony. It's been very interesting. We'll have you doing some handstands next time, I'm sure. But for now, we'll give it a miss. Thank you all for joining us.
Thanks for sparing me.
Thank you all for joining us.
It's been fun.
Any questions, let me know. jonathan.raymond@courtachievia.com, and we hope to see you next time. Thanks very much.
Thanks, Anthony.
Thank you.